Welcome back, everyone. Michael here with Offshore Citizen. One of our viewers, Diego MP, thank you, Diego, asked a question about exit tax on if you were to depart. He was referencing Canada in particular in the question, but it applies for a bunch of other places as well, which is if you are, let's say, a citizen or a resident of a place, and you own a foreign company, and then you leave that place, and you have an exit tax, how does this work? So I'm going to discuss that topic with you today and explain a little bit about how it works. And for anyone else who has questions, please put them in the comments below. I would love to answer them for you, so put them down there. Thank you again, Diego. And let's dive in. Before we do that, if you haven't already, please hit the subscribe button, hit the notification bell, hit the all notifications. It's a long process, I know, but it will make sure you don't miss out on any of our future videos. And if you would like help with relocating abroad, getting second residencies or citizenships, figuring out the best solution for you, or structuring your business internationally for tax optimization or asset protection, forming companies, opening bank accounts, etc., please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message to our websites, offshorecitizen.net or offshorecapitalist.com. Okay. Now, so let's just give kind of a quick little thing. What is sometimes called an exit tax, sometimes called a departure tax. It's a little bit annoying to Google it, because if you Google it, you'll sometimes find that it brings like when you're traveling outside of the country thing. So it's a little bit, anyway, the whole point is this is a tax that is incurred in some countries where you are resident there and then you cease to be a resident there, okay? And by this we mean a tax resident, not necessarily a legal resident. So you could be a legal resident without being a tax resident, right? And so when this happens in some countries, for example, Canada, you get a deemed disposition of most, if not all, of your assets. Okay, what does a deemed disposition mean? It means it's as though all the assets were sold, and whatever gains you would realize, you pay tax on, and then off you go. Okay, so in this example, that's not just domestic assets, and in fact, in some cases, domestic real estate is exempt because you're going to pay tax on it anyway. So, for example, in Canada, domestic real estate is exempt when you exit. But let's say that I own a foreign company. Okay, what's going to happen? Well, that's still one of my assets, so it's still a deemed sale of that asset. Okay, so I own shares of foreign companies. Whatever my cost basis of that share is compared to the current value of the share, I'm going to pay basically capital gains on that difference. Okay, now of course, the thing is, once I'm gone, that's it. I don't have to worry about it because it's a foreign company. And this is different than if you owned a local company, right? So, for instance, in the case of Canada, when we do international optimization for Canadians who are actually staying in Canada, usually we want to have a Canadian holding company with a foreign company in it. But if you were just going to be holding the company and then leaving Canada soon, it's often better to hold that company separately, because otherwise what happens is once you depart Canada, first of all, that's not what's called a Canadian-controlled private corporation, so there's some special rules around that. And second of all, you're going to be subject to dividend withholding taxes. So if I have to flow the money from this company to here, then pay dividend withholding taxes, whereas I would just pay it from here directly and not pay dividend withholding taxes, that's worse. So there's some planning that goes into this. This is generally the case for countries that have this sort of exit tax. Okay, you would have something similar if you were, say, an American who was subject to an exit tax because you were renouncing your citizenship and you were a covered expatriate. This would apply if you were, an Australian who was leaving and paying their exit tax, etc., etc. So all different countries have different rules around exit or departure tax, but generally speaking, that same principle applies. Of course, let's just say that that foreign company was deemed a Canadian tax resident because of the management and control. Okay, so let's use this as an example. Let's say you're somebody in Canada. We'll use Canada as the example here. You form a foreign company. Okay, let's just say that you do it in some place like Hong Kong. Okay, and because you're controlling it from Canada, it's considered to be a Canadian resident company. Now you leave the country, right? Now that company, of course, because you're no longer managing and controlling it from Canada, is no longer a Canadian tax resident company for the purposes of that. You still pay your exit tax, etc., but it's not a Canadian tax resident company anymore, and you can operate accordingly. So I hope that answers the question, gives a little bit of an idea. If you have further questions, put them in the comments below. If you would like to see any particular videos that you'd like me to make, please put them in the comments below. I'm happy to try and produce whatever it is that would be helpful for you. And please subscribe, hit the notification bell, hit the thumbs up if you liked the video, share it with your friends. If you didn't, please tell me why. And I'm going to look forward to seeing you guys on the next video.